Beef Market Update with Ann Dunford on RealAgriculture.com is brought to you by Haney Farms. Do you need seed? Find us at HaneyFarms.com. We're here for another edition of the Beef Market Update with Ann Dunford on RealAgriculture.com. Welcome today, Ann.
Hi, Sean.
And, well, it is another crazy week, really, when you look at it. The bearish tones in the market for Canadian dollar, for corn in 2012 is just gaining momentum. And a lot of that's based on the world economy or the world economic collapse that a lot of people are speculating, specifically in Europe. Mm-hmm. What are you seeing in terms of the cattle? Can cattle markets sustain this sort of bearish overtones?
Well, first of all, it's very difficult to talk about our demand markets on a week-to-week basis. You got to look at it from the big picture. So let's look first of all just kind of back in the rearview mirror what's happened in 2011 and why cattle prices have been so strong. And we have to, in this case, we have to talk about the North American market. And there's no question U.S. beef demand was up 7% in 2011. And a lot of that was driven from export demand, okay? But nevertheless, it's demand. And granted, we have ridden on the tails, or Canadians have ridden on the tails of that. Right now, the forecasts that I'm hearing from the outfits I use in the U.S. are basically suggesting, let's be a little cautious for 2012 and talk about flat demand, so no change. But what we've got going on, Sean, is you've had smaller supplies here in 2011. So smaller supplies plus a 7% increase in demand. That's given us the prices, record high Canadian fat cattle prices. And then you add to that next year, even tighter supplies in the US and Canada, especially the latter half of the year. And even with flat demand, Sean, it's going to mean solid pricing. Now, I don't want to discount how the global demand could impact everything around this. Maybe we aren't flat for demand next year, but that's kind of what's out there. So it's really that whole shrinking supply combined with even flat demand is pretty good prices. But let's go on and suggest, though, that the marketplace is pretty much already anticipating all of that.
Well, what's interesting, if you line this up, if we see money coming out of the euro going into the US dollar, that's not good for Canadian dollar. So let's say the Canadian dollar drops to 90, 85 cents. Then we look at the story on corn is there's evidence out there. We've got corn that's dropped $200 a ton since August in the March future. Mm-hmm. This is lining up, and if we hold demand, this is lining up to potentially be a great 2012 for cattle feeding, potentially.
Well, yeah, okay, fair enough. But you know what happens in the cattle feeding community when we see cheaper feed and tighter feeder cattle supplies, which is, kind of like you say, is what it's shaping up for 2012. Then there's no question we're going to continue to push feeder cattle prices pretty strong. So depending on what side of the fence you're on, if you're a seller of those feeder cattle, it looks pretty bullish. It's going to mean some pretty high break-evens, I suspect, because even if we give it back on the feed grain side, we'll give it up on the feeder cattle side. So, be careful talking about strong prices automatically meaning big profits. Those could be two different scenarios. Look in the U.S. today, December cattle break-evens for live cattle today for cash cattle about 122, and we're going to probably trade at 17. So even with these great prices, we've got cattle feeders losing money. So just be a little careful with that.
Okay, so we can agree, though, that this is going to be possibly, realistically, a high probability, a great year in 2012 for the cow-calf producer.
Oh, I think I'll go with you on that one. And again, the biggest unknowns when you start talking about that sector is, of course, what happens with moisture, what happens with, grass supply, forage supplies, and feed.
This is a reversal, Ann. You're being bearish and I'm being bullish.
I know I'm having trouble.
This is a crazy Friday. So let's look at the third cog in this wheel, which it can't be a good story. The packer. They've really got to be concerned about what they're seeing in front of them here.
Yeah, again, picture them in the same kind of margin operator hat as we've just discussed with the cattle feeder. Supplies are going to be tighter. He's going to spend more money for them. How much can he get out the other side? Now, a weaker Canadian dollar could put him in a little better frame of mind from an export perspective than we had in 2011. I think the Canadian packer really struggled. We averaged over par for the year in 2011 on the Canadian dollar. That's it's not a warm and fuzzy feeling from exports. So that, if your scenario of a weaker Canadian dollar is the case in 2012, that would most certainly help. But demand has got to, support higher, as I suggested to you in your article last week. It's got to support higher wholesale prices. It's got to support higher prices at the counter. And that's the only way the Packer's going to see his way out of this thing next year.
It is going to be a very exciting 2012. And next weekend, we're going to try to get together and we're going to talk about maybe some of Anne's Christmas wishes, or what Anne wants for Christmas for the 2012 cattle season, maybe.
Okay, I'm on.
Have a good weekend.
Okay, thanks, Sean.